So I'm joined here by Audrey Carlson, our in-house BTR expert, and we want to just chat about what we are both seeing and what we're seeing throughout our company with all the market studies we're doing in BTR. And by the way, we're doing more market studies now than we were 12 months ago for BTR. And so to me, that's a leading indicator. There's interest in getting deals. And so I'll kind of segue right into this question. Is capital interested? A lot of the BTR developers are saying it's hard to get equity right now, but there is interest, isn't there? I sat next to an equity provider at the National ULI meeting, and she's in equity. And she said, yeah, we're underweight real estate. We need to get some more BTR projects into our portfolio, and we're seeing more transaction activity in BTR. And, I'm curious what you're seeing, Audrey.
Absolutely. I think we're seeing a huge influx of people wanting to get into the build for rent space and equity coming off of the sidelines. I think in 2024, especially, there was just a massive pause as both equity and builders and developers really had to reconfigure their strategy and figure out how they were going to adapt to this high interest rate environment. So I think everybody's kind of coming out of the gates and ready to get involved again. And we're seeing that in the influx of market studies that we're doing for a lot of builders and developers. I think what we're going to see going through 2025 and then into 2026 is we're going to see that new strategy in terms of what market selection equity and builders are choosing to go into. And I think that's really going to be very dependent on the supply and the demand specific to each one of those markets. There's a few markets that we've seen some oversupply in, and that is being successfully absorbed, and that demand is remaining very high. But there's also some markets that have been kind of the underdogs. Think the Midwest markets, where they're still seeing very high demand and very low supply in the past couple of years relative to the Austin market and the Phoenix market and other markets like that. And so I think we're going to see a shift to focusing on some of these underdog markets, as well as new improved product. So that's what we'll be looking out for this upcoming year.
Yeah, and there's certainly been challenges in terms of all of the multifamily and BTR product that's been hitting the market completed in the last 6 months or 12 months. And that's going to start to change. And we'll talk more about that in a minute. But in the meantime, sticking with the subject of capital, you look at Avalon Bay. They've just purchased some big BTR developments, and they're expecting to put out $1 billion in total. Got Blackstone, Invitation, Pretium, expanding their BTR portfolios. And of course, one of the big stories, JP Morgan combined with Georgia Capital and Perrin Homes forming Lassiter Development Group and planning to do a lot of BTR development going forward. And so I want to circle back to that subject of where we are today in terms of supply and where we're going. And by 2026, 2027, it's going to be a whole different ballgame in terms of supply and demand. Uh,
Absolutely.
we've seen this huge drop off in starts, which we've discussed at length. And so that can only mean there's going to be a drastic drop in deliveries going forward. So projects that deliver into the market in 2026, 2027 are going to have a lot less competition to worry about. And if you look at this graph, this is data from Yardi Matrix. And on the left, you see the bar chart that shows not only BTR, but also multifamily, the two combined. And the much larger part of obviously is the multifamily. But what you see is for both of them, we're going to see a huge drop off in the number of completions or deliveries over the next couple of years. And on the right-hand side, you see the data on just the BTR. Forbes asked me to write a regular column on real estate. And so this was our latest topic, the nosedive in BTR production creates an opportunity for developers. And it really relates to basically these numbers. And you see that we've gone from 36,900 BTR deliveries in 2024 to Yardi's estimate of 19,177 that'll be delivered in 2027. I think that Yardi has a good visibility into what's going to be completed because they know what the timing is for these projects getting started and which ones are in the pipeline and which ones are likely to complete in these various years. And I'm going to zoom in and see this more closely. So there's a 48% drop in BTR completions that it's expected by 2027. So that's very significant. So there's going to be a lot less competition in the market in a couple of years. And that's something that a lot of our clients are talking about trying to take advantage of. Not everybody can do it. Not everybody has the capital to do it right now, but those who have that kind of funding are going to enjoy a very low competitive environment.
Absolutely. And I think looking at that Yardi data too, something to take into account is I'm sure some of those numbers are being fueled by planned and prospective developments, which we all know may still be stalled further. And so some of that pipeline that is set to come on the market in 2026 and 2027, that actually may be slimmed down even further. So I think the 48% is potentially conservative. I think just looking at the amount of market studies and activity in the market, especially in 2024, which really just hit a baseline. I think the dip in supply in 2027 is going to be even more drastic. And so what does that mean for communities that are actually coming online in 2027, the very few build for rent completions? Some of the things that we're working on with clients when we're taking a look at delivering into such a low supply market is you're going to have a massive increase in absorption. So some of these markets, we're seeing very slim absorption right now because there was a huge influx of supply delivered in 2024. And so as that supply is being absorbed into the market, we're seeing some slight decreases in occupancy levels, and in some cases, rent and rent growth. But when we're delivering product into the 2027 market, we're going to see a lot of rent growth is based on what we're projecting, as well as a much higher absorption rate. So that's fantastic for some of those communities just because they'll be able to capture a much larger market share.
Agreed. Yeah. And Audrey, what is your view on how developers can maximize their success in terms of how to optimize their product, the number of bedrooms, the square footages, and so on?
Yeah, I think this is so important to really focus in on what product you're building. We can't just build any product and expect it to perform well, even in a low supply market. And so I think some of the shifts we're seeing is a shift into more 3-bedroom homes rather than the 1 and 2-bedroom homes. And I think part of that is fueled by the huge supply of traditional garden style multifamily we've seen over the last couple of years. And those are traditionally more 1 and 2 bedrooms. And with the housing inaffordability right now in the market, there's a lot of families that are having a hard time purchasing a home, and therefore they are being pushed into renting a home. And they can't be renting 1 and 2-bedroom homes. Typically, they're going to be looking for those 3-bedroom homes, and in some cases, even 4-bedroom homes, which is a huge opportunity for builders and developers today to reconfigure their product mix. And on the backside, also for the build for rent operators, 3 and 4-bedroom homes typically have a higher margin as well. So you can see a push up of the returns on each one of those floor plans, which then looks a lot more attractive from an equity perspective as well. So of course you still have to have the balance, making sure that you're building the right product for the demographics of the market you're looking at. So here we're looking at build for rent completions by bedroom count. So you can see the split between 1, 2, 3, and 4-bedroom homes and the percentages based on each year. And so we are seeing the gray there, which is the 3 bedrooms, and then the lighter gray, the 4 bedrooms. The 3 bedrooms especially, we're seeing are increasing in the unit mix, which is something that we've been projecting for the last couple of years, as there's been a very large influx of horizontal apartment model build for rent deals, which is traditionally more heavy on 1 and 2 bedrooms. We're now starting to see a shift into those 3 bedrooms. And I think that's specifically to meet this high market demand from families or growing families specifically. I think 2, 4 bedrooms, I've seen some very successful build for rent projects, whether it's in Texas or the Midwest, where they're both seeing huge premiums on having those larger floor plans with more bedrooms. So I think as we get into the next 3, 4, 5 years, I think we're going to start seeing that share of 4 bedrooms start to increase as well. But the 3 bedrooms too, when you're looking at an operating perspective, you typically see some very high premiums for 3-bedroom homes over 2-bedroom homes. And that's also a trend that we've seen be increased by the whole COVID pandemic. As more people were working from home, they want that extra bedroom for a home office and a little bit more space to grow into.
And what, what about the importance of garages and interior features? And by the way, we do a type of study that's we call a product optimization study, or that can be a module within a market study that we do for a particular project. And can you talk about some of these types of features and how important they are?
Yeah, I think the home amenities are becoming more important. Build for rent is a very unique asset class where the home itself, the unit itself, can actually be the amenity. And so that's why there's been a lot of operators that have really played with, do we have to have community amenities? Do we have to have these massive amenity packages, or can we just have a 2-car garage and a fenced backyard in our homes? And I think the solution to that really is going to depend on the market you're building into, but it is a unique opportunity for build for rent developers to be able to really focus in on making sure that they have those 2-car garages. In some cases, maybe more infill markets, you can absolutely get away with 1-car garages. It still can provide a great premium and reason for renters to rent a build for rent home over a multifamily home. So some of the premiums I think are important to touch on is for an attached garage, we can see $75 to $250 in a monthly rental premium on having either a 1 or 2-car garage, which is huge when you're taking a look at monthly rent and the revenue you can receive for those units. As well as a fenced backyard can be on average about $100 to $150 in premium on your monthly rent. So those are some easy solutions that you can not only increase your tenant retention, but also increase your monthly rents. Now, of course, you're giving up a little bit of density if you're going to go with a 2-car garage, just because it typically does require larger lots. But I think that's a really good trade-off.
Yeah. And I'm going to hit you with another question, Audrey. You've been doing, you've been leading the research for us on some projects in Phoenix. What can you tell us about the Phoenix market? That's always an interesting one because it was really kind of the incubator for the BTR industry.
Absolutely, and specifically for the horizontal apartment model. You know, I personally live in Phoenix, and just driving along all the highways, you see these horizontal apartment build for rent deals everywhere. And so it's interesting diving into a market study that we're doing recently in the submarket of Buckeye. And even with the massive influx of supply of these deals, it's amazing to see that occupancy is still very high. Rents are still very high. They really haven't dipped into the negative. Yes, there's very slim rent growth, but I think as we get into 2026, 2027, we are going to start to see that positive rent growth again, even in the Phoenix market, which some may say has been pretty oversaturated relative to the rest of the country. We do have a very large percentage of institutional SFR and build for rent activity in Phoenix specifically compared to the rest of the US. But I just think that the demand is able to really absorb a lot of that supply. And so that goes to show that a lot of people are still moving into Phoenix, still looking for this quality rental housing and something that's different than your typical apartment unit. So it's very interesting to see that even though we still have a ton of supply and a ton of great comps when we're looking at these market studies, absorption and occupancy still remains very strong.
Great to see.
So Brad, I would be curious, you know, as we're looking at interest rates and everybody's trying to figure out where are we going with interest rates? Do we project them to go higher? Do they project them to stay the same or even lower in some cases? Do you have any insight on that for 2025, 2026?
Sure. And it's this strange situation, of course, where short-term interest rates have come down, but long-term interest rates have remained high. And that's because of the massive budget deficits we have, the huge amount of debt service, and there's more treasury issuance coming as the budget deficit gets higher and higher. And, you know, along with that is, of course, inflation expectations that govern long-term interest rates. So with you know, lower rates on the short end and higher rates or flat rates at the high end, higher for longer, what are the implications? Well, you know, somewhat shorter end is the cost of capital for BTR development. And that's still an issue, but I guess I feel like at this point we kind of know where it's going to be. There was a lot of confusion and a lot of speculation as to is SOFR going to get back down to where it was? And because that's one of the indices for the cost of capital for these kinds of developments. So, SOFR in early 2023 was 4.6%. By early 2024, it was up to 5.3%. Now it's 4.33%. So it's come down a little, and that is of some help, but there's still a lot of gnashing of teeth about the lack of equity in the market. So again, it's down to the projects and the sponsors that can get money behind them and get moving. So it does just create this sort of opportunity for people that have better access to capital than others. And so I think that, the other part of it is mortgage rates remaining high means that more people are having trouble affording purchasing a home. And so many of them are falling back to the rental option. And when there's $1,000 or more difference in the monthly payment, it's pretty easy to justify saying, okay, I'm just going to rent a single family home instead of buying.
Absolutely. And I think that's the shift. I mean, we all have to figure out how we're going to get more deals done in this new environment. Really, this is the new normal, and we have to get creative and refine our strategy so that we can continue to develop these deals and operate these deals. And I think that's the big solution here is shifting your focus on looking at the problem of this high cost environment and how can we provide a solution as build for rent developers, investors, operators into providing a solution for these home buyers that are being priced out and are now our potential tenants for these build for rent communities. So that's really how we have to look at this. And I think that's another strategy when you're making a successful build for rent community is to consider the psychology of your potential renter. What are the pain points that they're dealing with in this market? Are they looking for a very maintenance-free lifestyle to take some of the stress off of some of this higher cost environment because they're feeling it on all sorts of levels, not just within housing, but also in their grocery costs, or just their spending habits in general. And so I think there's a lot of solutions that build for rent communities can offer these potential tenants in just having a more relaxed lifestyle where they can give the maintenance to the landlord and not have to take that on their shoulders. And they can end up spending more time with their families, which I think is what everybody's looking for.
Yeah, that's right. And then the other thing that's on everybody's mind is the cost of construction. And I don't see that really bringing much relief or affordability getting any better for that matter. You got the tariffs that are boosting the cost of lumber and appliances, and 32% of appliances and 30% of lumber come from abroad. The labor pool, is that going to be affected by the immigration policies and deportations and so on? So these are complicated questions. And then on just home prices, going back to the question of does somebody buy or rent, our forecast, and we were on a panel of economists to Fannie Mae, and our forecast for this year is 3.7% increase in home prices, slowing to 3.2% next year, and then picking up again a little bit after that. So again, on affordability, I don't see any particular relief coming. And on cost of construction, some things may move up, some things may move down, but the tariffs, I think, throw a real wild card into this discussion.
Let's see. So one thing, Brad, that I'm very curious right now, I feel like it's still very much a conversation that's being pushed by the media and also by a lot of the municipalities right now is that institutional single-family rental and build-for-rent operators are taking home supply away from home buyers. And how can we deal with that? What solutions are build-for-rent actually providing the buyer pool?
It's a really important question because it really goes to the possibility of additional regulations and so on this sector. And what we have to get out is the message that BTR is different from SFR. BTR is adding supply to the market. It's not taking away homes that other people would ordinarily be able to purchase and own. And so there is this sort of NIMBY feeling among some of the municipalities, local governments, especially with some of the newer kinds of product like the horizontal multifamily cottage style. A lot of the municipalities don't get it and have to be educated. But I think it is happening. I see that we're making inroads as an industry and as a sector, but it is definitely something to keep a careful eye on.
Absolutely. And I think in terms of build for rent, addressing the housing shortages by adding new housing supply that wouldn't otherwise be built, it's also providing a better opportunity for some potential renters who typically wouldn't be able to afford buying a home in a neighborhood that has great schools. It provides that opportunity to still live in that neighborhood at about $1,000 less than it would be to buy that same home, and provide better opportunity for their children as well. So I think there's a few different solutions that Build for Rent is providing. And then also being typically able to live closer into the city, just because people are having to drive to qualify to purchase these homes and are just being priced out completely from buying a home. And so they're able to still rent and be close to their workplace, close into all the conveniences of living within the city.
Yeah, that's right. And something else that comes to mind is uh, on the supply side, the builders on the for sale market have been having a lot of trouble lately, and their uh, confidence and sentiment has gone quite negative lately. And builders are seeing their sales slow down, their traffic is lower, they're seeing more inventory piling up, and maybe that creates an opportunity for operators to buy homes and possibly at steeper discounts from retail. So there's that opportunity as well. But I think that the biggest opportunity is the sort of land deal where you can really open into a market where there's very little competition in 2026, 2027. And it brings to mind too that there's ways to niche into this market like luxury BTR. And you and I talked a little bit about that, larger homes and larger lots. What's your perspective on sort of that higher end BTR segment?
I think there's a lot of opportunity for luxury build for rent communities in the next couple of years, and specifically because we're seeing increased household income of the potential tenants for build for rent. So these are renters that are choosing to rent based on the lock and leave lifestyle, the very maintenance free lifestyle. And so providing more of these communities that are larger, more luxury homes that have the better finish levels, very high-end smart home technology packages when it comes to lighting, locks, thermostats, building in all of these amenities within the home and then within the community that are just increasing the tenant experience. I think these niche communities are going to become very popular. Now, it is going to depend on the market. There's going to be markets like Nashville that comes to mind, where you have a very high household income and a lot of renters looking for an alternative option that's not typically in the market right now. And so it is going to definitely depend on the market, but I think there's a huge opportunity for it.
Yeah, I agree. So I think that brings us to the end of our discussion for now, and we'll be back with more. But I think that going back to the interest rate question, I don't see any big change in interest rates unless we have a recession. We hope that that's not the way we bring down interest rates. Right now, we're seeing stabilized BTR deals trading in the 5.25 to 5.5 cap rate range. That's according to Strata SFR and some of the other brokers that we've been talking with. But obviously, the equity providers are looking for 6.5, 7 or higher on a cap rate basis for new development. Hopefully that comes down a bit as they get more confident. And I think that the forecast is that risk is going to go down. And part of a cap rate is risk, right? How much do you think rent growth is going to be there? And right now, there's a lot of hesitancy, a lot of caution about rent growth. But I think that as we move forward over the next 18 to 24 months, it's going to start to become clear that rent growth is real and that absorption paces are going to get better. So with that optimistic scenario going forward, we'll go ahead and end our conversation for this time around. And Audrey, thanks a lot for joining
Thank you, Brad.
and for listening, and reach out if we can be of any help. Thank you.